Alibaba had its IPO on 19 September 2014 at $92. 6 years later, the stock soared over $300, but currently it is back at $86. Many call anything China-related uninvestable, which is understandable. But on these prices, you would think there is limited downside and tons of upside. In this video, we'll discover if that is true. Baba's history dates back to the end of the last century. It was founded by Jack Ma and 18 other tech partners who wanted to leverage the power of the internet. The company started in a small apartment in Hangzhou, China. Jack Ma's first plan was to become English teacher. That idea was gone after he started using the internet. He typed in beer and it returned a list of results. Then he typed in beer and China, but it showed nothing. He noticed an absence of Chinese companies engaging in the e-commerce marketplace. When the company started, Amazon and eBay were already doing e-commerce. eBay was the biggest player in China with eBay China. Alibaba came up with Taobao.com, which would directly compete. They also made a messaging tool, Ali, and a payment tool, Alipay. Taobao was so successful because they would make their platform free in the first years, whereas eBay would fine pretty high fees. The Chinese government also helped them with internet control within the country, effectively locking out U.S. e-commerce giants like Amazon out of the Chinese market. In 2009, Alibaba announced their cloud platform. Jack Ma stepped down in 2013. In 2018, Taobao had 580 monthly active users, and Tmall, their other platform, reached over 500. Let's now take some time to cover all the parts of the business. Taobao. This means search for treasure, and is the largest e-commerce platform of the world. It has over $20 billion in gross merchandise value, more than 645 monthly active users, and is consumer to consumer, so this means small companies also sell here. Tmall. This is a premium platform for branded products and retailers like Nike, etc. 500 monthly active users, B2C platform. They started the business as a platform-only business, but are nowadays also doing logistics to control more of the supply chain. The logistics platform offers 24-hour delivery in China and 72-hour delivery globally. The GMV is 2 times higher than Amazon, for example, but the revenue is much lower. This is because Alibaba only takes like 10% of the transactions through their platform. Baba always did third-party sales only until recently. Taobao and Tmall are their Chinese platforms, but they also have international commerce with AliExpress, global retail for Chinese goods. Trendyol, dominant in Turkey for e-commerce and groceries. Lazada and Daraz, key in Southeast Asia. Moravia, Spain, focusing on a blend of shopping, entertainment. Lazada is pretty big in Southeast Asia, but there is serious competition from Shopee and many others. It's a tough business. That's the reason this whole international segment is not profitable, and I can image it will stay unprofitable for a very long time. In 2009, Baba introduced their cloud segment, which currently does about $15 billion in revenue. Whereas the cloud is a huge cash generator for companies like Amazon and Microsoft, is this not the case with Baba? The earnings before interest, tax, and amortization is less than $1 billion. The growth has also slowed down, as you can see. Cloud also includes their large language model called Tongyi Qianwen and a workplace collaboration comparable with Slack or MS Teams called DingTalk. DingTalk is the largest business efficiency mobile app in China by monthly active users. In March 2023, it has over 700. Alibaba also has some other parts of the business they note down under others. This contains Ile.me. This is food delivery platform. Number 2 in the market, Meituan from Tencent, leads with 69% market share. LA.me has 26%. LA.me was bought in 2018. A-Map is a navigation tool comparable with Google and Apple Maps. Yuki is a long-form video platform like YouTube, 443 monthly active users. Quark is a search tool like Google. Baidu is the king in this market, so it's not a dominant search tool compared to that at all. Xianyu is a second-hand good marketplace like Craigslist. These are all the segments Baba reports. I added it as a percent of revenue and the growth numbers. As you can see, basically all of the profit in EBITDA comes from their Chinese retail division. Furthermore, there is a slight profit in cloud and logistics. Alibaba has a 33% stake in Ant. Ant is Alipay. It has 50% of the payment market in China. Together with Tencent, it rules this market. Ant was valued at around $315 billion when it would go on IPO on 2020. It's now expected to be worth $78 billion according to Reuters. A significant drop, just like many other Chinese companies. Why is the Chinese tech index minus 60% and the Chinese index minus 35% since 2021? 1. The Chinese government aiming to prevent monopolies and take better control over big tech, Alibaba and Tencent. These actions made investors scared, and many will not invest in China. The government also stopped certain companies to be able to make profits, companies that educated children, for example. The result, you ask? The graph shows that very well for these education companies. 2. The second reason is the economic situation of China. There has been a very slow growth since 2021 due to the aftermath of the COVID pandemic and the way China handled that situation. Recent news of a stimulus in 2025 and onwards was positively accepted by investors. The economic situation obviously has big impact on Alibaba, and you can see that in the revenue growth. In the rest of this video, I will only be looking at the China retail segment here because all profit comes from it. I can do a full analysis on the other segments, but it won't make or break your investment. So I choose not to dive too deep in this apart from a few Google searches. In the last 5 years, quite a lot has changed. Before that, it was JD.com and Alibaba basically sharing the market. In these last years, there was the rise of two competitors, Pinduoduo and ByteDance's TikTok, or Douyin, how the Chinese version is called. An average Douyin user spends 110 minutes per day on the app. There is Douyin Shop version, just like the so-called TikTok Shop. This shop enables users to purchase products directly within the app. It integrates e-commerce features and people buy directly from influencers, for example, so-called social commerce. To give you a view how big influencer marketing is in China, in 2020, the influencer marketing industry in China was valued at approximately $14 billion. By 2024, it is estimated to have grown to around $24 billion, with spending projected to reach $29 billion by 2028. The other Pinduoduo grew by community group buying. This started in rural areas where Taobao was less active. They connect consumers together to buy directly from producers to get lower pricing. From what I read is that Chinese are all about the lowest price and are not loyal to a platform at all. Pinduoduo started with groceries but later did washing machines, iPhones, etc., the rest too. In short, Pinduoduo works like this. A shopper forms a team for a product he would like to buy. You can share that group with others and people can join your team. More people in your team means a bigger discount. More people means the group gets shared more, which leads to more discounts again. And more discounts attracts more people, which leads to more shares. It's an endless circle with discounts going up to 90% of retail pricing. Then these groups can go viral, which makes them land in more feeds, more people join, more discounts, etc. You have leaderboards, animations, etc. It's built in Tencent's WeChat, called the Everything app in China, and it mixes e-commerce and social media. The general consensus was that the rural areas where there was more poverty, which would eventually get richer, would be a huge growth market for Alibaba. But this growth has mostly been taken by Pinduoduo. Pinduoduo reached over 700 million active users in 2024, beating JD Taobao, had around 934 million active users. To defend itself, Baba focused more on the logistics to control more of the supply chain. It also came up with Taocaicai. This is their social commerce platform that is basically a copy of PDD's model, where consumer buy directly from producers together. This picture is pretty telling, the growth of Pinduoduo versus the slowdown of Baba. Of course, it is easier to grow harder as smaller players, so it will be interesting to see the future of these two. And that shows on the analyst expectations for the next 2 years. PDD is expected to growth 68% this year, 26% in 2025, 20% in 2026. Compare that with Baba, that is expected to grow 6% this fiscal year, 8% in the year after, 9% in the year after. So PDD is slowing the growth but still beating Baba by quite the margin. As I haven't been following the markets in China closely, I was pretty surprised how hard Baba's moat has been weakened. Baba is still the biggest by far though, but with PDD's growth and that from the Chinese version of TikTok, it's hard to predict how that will be in the future. What seems certain is that the priced-in growth, when the stock was much higher, has been taken by competitors. And the moat is worse than it was. This doesn't mean Baba can't be an interesting investment, though, especially because the most basic products will likely stay at Baba's platforms. Let's have a look at financials, management, and the valuation. They have a 38% gross margin, 14% operating margin, 9% net margin, and a 13% free cash flow margin. Alibaba has a perfect balance sheet with more cash than debt. Their 10-year return on invested capital is 11.7%. But in the last few years, with all the economic struggles, their return on invested capital hasn't managed to be above 10%. In fact, the lowest year had a return on invested capital under 5%, which really isn't good. The current CEO is Daniel Zhang, personally chosen by Jack Ma after he stopped. The CFO is Toby Hong XU. I find it hard to really measure this management team, but I think it's fine. What I like is that they do a lot of buybacks on the low valuation with like 11% BB yield now. They could even splash all their cash on buybacks, lend some more, and buy as much as they can on this low valuation a la Henry Singleton. Don't expect them to do that, though. I couldn't find any insider buying. If there is any lately, let me know down here. I did a reverse DCF, and with very reasonable growth numbers, this sounds like a pretty interesting to buy if you believe these numbers will be hit by Baba. Even though the situation with all the competition and the moat being less big than it was 5 years ago, I believe so. If you break it down with a sum of the parts method, the market cap of Alibaba is 210 billion USD with an enterprise value of 185 billion USD. If we calculate the stake in Ant 33% of 78,064.26 billion and remove it from the enterprise value, it is 159 billion. Looking at their cloud business, what is a fair multiple? Let's say 5 times sales for slow growth and smaller margins compared to US cloud. So 5 times 14 billion, 770 billion. If we remove the 70 billion from the 159 billion we calculated earlier, for we have 89 billion. So 89 billion for like 20 billion of earnings before interest, tax, and amortization looks very, very cheap in my opinion, especially if you consider this doesn't even take in their international businesses, which could lead to even more upside risks. China government and further loss of market share for retail segment. Opportunities, AI and the well-positioned in both e-commerce and cloud segments still. Personally, I think the impact of the Chinese government won't be as big as some people make it out to be, yet I still wouldn't invest in this company. If I would have to invest in China, I'd probably aim more towards Tencent. I think their moat is much stronger, or go for Pinduoduo. I was quite surprised by how well Pinduoduo competes with Baba, and additionally you have TikTok, which is so big, but don't have much data about them because they're a private company still. I think in conclusion, the share drop from $300 to $80 is a cocktail of 1. Government uncertainties, 2. Chinese economic slowdown, 3. Weakened moat, and a lot of priced-in growth taken up by new competition. So I don't expect this company to be trading back to all-time highs anytime soon. It can be a very, very interesting investment nevertheless, though. But not for me. Thanks for watching this video. I hope I was able to learn you something. I certainly did learn in the process. Would appreciate a like and a subscribe if you made it to the end of this video.